Buenos dias. Sorry I'm late. But where is everybody? Monday morning. Monday morning. I did receive your tests. I would like to grade them today and get them back to you before tomorrow. It looked okay. I have to go more carefully through people's work. Some students did solve a lot of the problems manually, and I guess that's just because of uncertainty. You didn't know exactly what you needed to put there, so maybe I can provide some feedback tomorrow about that. Hi, Daviana. So as I mentioned, I'm going to pick 2 questions and grade them, and the other ones I'll give you pass or fail grades. And there's only 11 students, so this shouldn't take me long. So yeah, I should get it back to you by tomorrow. So I wanted to start the new topic today, but what I will also do is share even more questions with you so you can keep studying the original material. I mean, you have a lot of problems to review and learn, but I'll give you just a few more for this week, and then give the solutions at the end of the week. So those are just for you to practice the old material. But we're going to start the new material. This topic is techniques for the valuation of alternative capital investment projects. Oh, and I'm going to also, that's another thing, I'll also put some review problems in Connect for you. Those are not for grades either, but they're supposed to prepare you for the final test. That's also going to be in Connect. You will have up to, well, I guess I have to make it unlimited attempts, but I'm not going to grade them. So I could just put 2 attempts and something like that. I'll think about it. So review problems for this week. That will include the old material and maybe some of the new material. And that's just to keep you prepping for the final. And in the meantime, there will be a test next week on what we do this week. So I want to cover this unit, I call it Unit 3. And then I'm going to get into a review of statistics. Let me check something. Oh yeah, we have to do capital budgeting this week. Okay, so this and then capital budgeting. And then we need a stats review before we start the last week of material. So maybe I'll give you some reference for that, or maybe I'll teach it. I don't know that I want to spend time on the review for statistics, but I want to make sure that you do understand it because it'll make the last week much more easy. Okay, looks like most of you are here. So what we're going to do next is talk about alternative approaches to valuing projects. So far we've learned essentially techniques for valuing a variety of assets or securities and contracts, right? We valued a number of items. And now we're going to talk about valuing projects. We did that, we looked at investment opportunities with the net present value rule. So we're going to start there, and then I'm going to teach you about alternate rules, a set of other rules, and we'll talk about the differences between them. Okay, so in doing that, when I talk about valuing alternative capital investment projects, so these are options for investment from a firm's perspective. It could be an individual perspective too. I mean, the techniques we learn are not just for the corporation, specifically looking, but we're going to take that perspective for the problems, okay? So we're going to imagine that a firm has determined a set of future cash flows that they anticipate, and they're going to value them. And when they look at a project, they might do something like we already discussed, check if the net present value is positive. If so, they will proceed with the project. Now, what if there's another project, a competing project? Which one should they pick? Well, they can stick with the net present value rule, calculate it for both sets of potential cash flows, and then choose the project with the higher net present value. That's an alternative. That's an approach. So when you are valuing projects just by a rule, not comparing it to anything else, not comparing it to another project, what you're doing is conducting an independent project analysis. All right? And you're accepting or rejecting one project does not affect the decision of the other projects. So in these cases, your criteria will be such that, either you have to exceed a minimum or not exceed a maximum, and we'll talk about some alternatives. The other approach is where you have to choose. You have to choose between two projects. The firm is not in a position to take on additional projects, so they're just going to choose the most profitable one. That's known as mutually exclusive project analysis. And finally, what if a firm can choose more than one project, but they are, they could choose among a combination of projects. So let's say there were 3 projects, and I will give you an example like this. If there are 3 projects to choose between, either you can take one project or some combination of 2 of them, but you can't take all of them. So it's better than mutually exclusive project, because in mutually exclusive you just pick one, but in capital rationing you can pick more than one, but you have a restraint. The constraint is that you can't spend too much money. You have a budget for only so much. Okay, you have only so much access to capital, to financing, to money. So we're going to talk about that at the end. All right. So valuation is really an art. Now you're going to see I've simplified things for illustration and for teaching purposes, but in fact it requires broadly three things that or you can estimate the amount of each cash flow at each point in time. And again, we're going to stick with end of period cash flows, understanding that that is a simplifying assumption. Although, cash flows could occur at any point in the period, we're going to refer to them as end of period cash flows. So finding those, determining what those are, who even really knows what things are going to cost in the future? Well, you go by some estimate of what things cost today, and you think about inflation, you think about market forces, you think about the sector, think about competitors. Okay, so you have to think about all these things when you put together each cash flow. Now, the cash flow is going to be made up of many things, right? You're going to have revenues, you're going to have expenses. But in the end, you need a cash flow at the end of each period. So that takes some creativity, and you'll see you get a really good feel for that when we get to capital budgeting, Unit 4. You need to use the right risk-adjusted rate of return, the appropriate risk-adjusted rate of return. And I refer to that as RRR. Again, this is just our interest rate. This is our I. This is just our I. But when we speak about investing in a project, we think about what could we do otherwise? Like what is the prevailing interest rate that we're operating under? If we weren't investing in this project, then we believe, or we would be prepared to invest, provided the rate of return is estimated to be, 8%, or maybe want to compare it to the stock market, which is 12% on average. So that would be our I for our anticipated future cash flows. Finally, you need to know the timing of payments, and like I just mentioned, usually we'll have the payments considered at the end of the period. It's a matter of knowing how far off in the horizon you imagine your project will operate, and when each cash flow will accrue. So this involves a lot of consideration and assumptions, and maybe you don't want to just set up one analysis. Maybe you'll do several. Okay, you make a series of estimates and see if the project is acceptable in all of them or when it isn't, and you get a better feel for the viability or the profitability of the project from your firm's perspective. All right, so we begin with the net present value rule as a review. Remembering the net present value is equal to the initial investment as a negative cash flow plus the total present value of future cash flows. You need to estimate the initial cost, the future cash flows, how much and when, and you need to estimate that discount rate, the required rate of return. For independent projects, your minimum acceptance criteria will be that you accept all projects with a net present value that's positive. If you're choosing between projects, you choose the one with the highest net present value. Hello, Angel. So here's an example. Assume you have the following information on project X. The initial outlay is $1,100, and you can think of these as thousands of dollars, so that would really be like $1 million, 1.1 million. But anyway, let's work with small numbers. It just facilitates the demonstration. But in your mind, you could see it follows to, higher values. So the required rate of return that's been determined by the firm is 10%. Here are your revenues and expenses, and we've collapsed them into this column of net revenues. So those are going to go into our timeline. So here they are. The initial outlays, revenues minus expenses gives you 500, 700, minus 500, and 1,200. To calculate the net present value, algebraically, you need to write this expression. That's all I need to see on a test. And then the answer and your decision. Oh, you can't see the answer. So it says, let me just make this smaller. That's not going to help with the cover up. So it turns out that the project should be accepted on its own merit as an independent project because the net present value is positive. Sorry for the noise. You can remember how to put that in your calculator. I left some space here in the notes in case you're printing. So in our calculator, we're going to use the CF keys, right, as mixed cash flows, entering these at a 10% rate. And then calculating NPV. Let's see if I can do that. Oh, that's not it. Hit the CF key, right? I have something in there. So second, clear work. And I begin to enter 1100 negative, enter down. Then 500, enter down, down. And then 700, enter down, down. And 500 negative, enter down, down. And 1200, no. No. 1200, enter down. And then down, down. And then NPV, put in 10%. Enter down, compute. And that's your answer. That's your answer. Any questions? All right, so any questions about the net present value rule? Now we'll understand the virtues of the net present value rule when we begin to compare it to other methods. It is common for an investor to ask, how long does it take the project to pay back its initial investment? It's a fair question from the investor. It's a fair question from a management perspective. It's a fair question from the board of directors in a corporation. When does the initial investment pay back? So this is a common discussion point. What are the number of years to recover costs of a project? This is known as the payback period. And then management would determine what would be acceptable. Let's say they decided that if the project doesn't pay back in 2 years, we will not pursue the project because they can't spare, they want to be liquid. They don't want to be so taxed with projects and having their financing locked away, not generating revenue or not generating substantial revenue, that they still don't pay, it hasn't paid back the initial investment. So that could be, a 2-year recovery period. If you have several projects to choose from, you'd have to establish, management would have to be clear about what would be the acceptance criteria or which project to pick. You could rank the payback periods and pick the one that pays back sooner. That could be the way to think about it. All right, so here's an example. Let me take, so let's just take this over. Oops, what just happened? And I can't undo that. Well, that's not what I want to do, but okay. So what we're going to look at is this set of cash flows with this initial investment and this cost of capital. This is also the required rate of return. It's referred to as the cost of capital because a firm requires what the firm has a required rate of return based on what they'll have to pay out to the, so it says cost of capital, so to in terms of stockholders, it would include the return to equity, and if they have stockholders and bondholders as financiers of the firm, then it would be a combination of the two, and you may have seen this before. So the required rate of return is also called the cost of capital. So here are the cash flows. Here's the initial layout and the predetermined cost of capital. And if we were to discount these cash flows, we would get these amounts. Okay, so these are the discounted cash flow. So why am I doing this? What I'm doing here is looking at the cash flows because I understand the time value of money, simply using this stream of cash flows and saying, well, I need to make back 1,000, so I'm going to make back 200 at the end of year 1, 400 at the end of year 2, so somewhere in the third year, costs are recovered. Well, that would be the payback period rule. But yes, Angel, you put the 10% in the interest. So I was saying, if you just added these and ignored the time value of money element, then you'd say it pays back in the third year. So because it doesn't pay back in 2, if that was the preset amount of years, then you would reject the project. But we know better than that. We know about time value of money. So we're going to discount each of the cash flows and then add them together. So as we add them, here are the accumulated discounted cash flows. So here's the first one. Here is the second one plus the first one. That's how much. By year 2, this is the present value. Including year 2. I think that's the best way to say it. This is the present value including year 3. So again, you see it's in the third year that the cash flows pay back. So how much of the third year? We just have to get to 1,000, right? So to figure that out, we're going to begin with 2 years plus a portion of the third year, not the whole third year. So to get the portion of the third year, we're going to take the residual, or the remainder, or I think, you know, the resto, is that how you call it? You take the remainder from 513 so this amount is 1,000 minus 513, and then you spread it out over the third year. In the third year, you're going to make 526, so you have to go back here. So you spread it out over the dollars in the third year in present value terms. These are all present value terms. And it turns out to give you almost the entire year, 2.93. So just before the third year ends, the project pays back. So to evaluate that, it depends on what your threshold was determined to be. If 2 years was the cutoff, then you would reject this project. But what if 3 years was? You would accept it. So if 2 years was the maximum amount of time for the project to pay back, reject the project because it's over. But if 3 years was, then you accept the project. Oh, look at this typo. I have to fix that. So what is, now we're going to contrast it with the net present value rule. What is the advantage of doing things this way? What is the disadvantage? You guys can read ahead, or you can tell me what you think. So to recap, we want to determine when the project pays back. We could do that here and say just add these together. 2 and 4 makes 600, plus of another 400 would make 1,000. So this is somewhere after the second year, in the third year, that it would pay back. And then I said, well, you can't just do that now that you know time value of money. You probably should incorporate it. So these are the present value amounts of each of those cash flows, and I've added them together to look at them and notice that, again, by the end of the third year, the project pays back. Because we've incorporated time value of money, the amounts are all smaller, right? Because future dollars are worth less. So in present value terms, it takes longer to pay back. So we get 2.93. So the issue here is that, notice I didn't use the number, the fourth one. I didn't use that. I didn't need it. All I needed was the information between, well, the first 3 years, and the information between the second and the third year to determine with the closest year plus the remainder divided by the present value of future cash flows. Those are the only amounts that I needed. So in essence, we are ignoring anything beyond that. Is that wise? Should we be so firm about saying it's going to be a 2-year project, or that the project has to pay back in 2 years or 3 years? Should we be so firm if the fourth year turned out to be a banner year, a great year? What if year 4 looked like this? What if it wasn't that it was $300,000 cash flow anticipated, 10 times more than anything you saw before? Roughly. Roughly 10 times more. But anyway, much more than you saw before. Well, you'd be ignoring this figure, and that's inappropriate. What if it was negative? In the first case where you saw positive, you could say, well, wait a second. I'll rethink my threshold and say if it doesn't pay back after the fourth year, then I'll reject the project, because you want to take advantage of that future cash flow, that, that's a windfall of money. So that's one thing, but what about on the flip side if it was a negative? Well, that also should be considered, not just the cash flows before it, because this is saying, you might go through the trouble of starting this business and realizing these returns, dollar returns, but in the end you're going to get hit with the cost or expense or whatever's happening in the fourth year. So that could happen if, say, you're running an environmental project and then policies change, rules change, and you have to restore your land or your property to some sort of new standard. Not restore, but you have to upgrade to a new standard, and that's the estimated cost. Does it look like it's worth it? Probably not. So these things have to be prepared for, and sometimes you can't. But in the end, the payback period rule is nice. It's important information, but as an information, as a data point, as information alone, it's insufficient because it ignores future cash flows. So the disadvantages are that this maximum acceptance criteria is arbitrarily set by the management. And what does that do? You end up not considering all the cash flows, and you might be missing important information about future possible detrimental cash flows or windfall cash flows. And they should be included in your analysis. So that's why you would put that together with the NPV, so you have a measure of all those cash flows combined. All right, so far we've discussed the NPV, that gives you a dollar figure, and the payback period, and the discounted payback period. And these gives you years, measures of years till recovery. Well, what if we now talk about another measure that's useful, and it gives a percentage. It's something that you will compare to the required rate of return for the project. It's known as the internal rate of return. You compute it as the discount rate that sets the net present value to zero. So it's the break-even discount rate, and you're going to use it to compare to the required rate of return as a return on investment. What we're going to do is evaluate projects on their own, independent project analysis, and we're going to compare the rate of return to the required rate. And if it's enough, higher than what's required, we accept the project. We're going to talk about these disadvantages and correcting for them. And what's the advantage of this? It's a single number that gives a lot of information. But like the payback period rules, it's not used in isolation. It's used in tandem really with the NPV, and you'll see what I mean when we get through this. And finally, I'm going to talk about mutually exclusive projects. When you have mutually exclusive projects, you should select the highest internal rate of return, but I'll tell you what the restrictions are on that. You can't always do that. It's very important to know your limitations in using formula or approaches, so we'll talk about that. Here's my first example. And I did ask you to make sure you have a calculator with internal rate of return on it, right? Here's the initial investment, and these are the future estimated cash flows, all end of the year cash flows. And find the internal rate of return such that the net present value is 0. That gives you this formula here. So notice I've replaced the interest rate with the internal rate of return. Now we need to calculate that. Could you calculate that analytically? Could you isolate? You won't be able to isolate the internal rate of return on the one side with algebra, because these are all raised to a different power. It will be a huge mess, and you'll have a polynomial. So what it is this is the internal rate of return in here that satisfies the break-even net present value. So as long as that's higher, it's like a required rate of return. Sorry, it's like a return on investment. And we're going to compare it to what we require, the required rate of return. Now you could write it like this, or you could move the value to the other side and write like this. I want to make the point that we cannot isolate the internal rate of return. What we can do, and what the calculator has been programmed to do, is to iterate, to put values in here and try and approach either 0 or this value, depends on the calculator, or the programming. So think about, as you put in higher and higher values of the internal rate of return, starting with low values, like 5% or even 0, putting those in here, but then going higher, the denominator will go down. Sorry, not the denominator. The number will go down as a consequence as the denominator goes up. So as the numbers go down, the total will be smaller and smaller and smaller. This would be decreasing. It will be decreasing and less capable of offsetting this negative value here. So let me show you this drawing. This is the drawing of what I just discussed. So we're entering into that equation higher and higher values of the internal rate of return and calculating the net present value. Initially, if you let the discount rate be 0, so if you let this be 0, what do you get? If this is 0, then you just take, this will be 1, 1, and 1, and 1. You add those up and you add them to offset the initial investment of 2,200, and you get 1,600. So that's where that number comes from. But then, as you put higher and higher discount rates, the net present value decreases. And what we're looking for is for it to be 0. So we're looking for it to hit here. And here, where it's 0, is where we find the internal rate of return. And in this case, it's very high. It's 23.3%. So what does that tell us? I mentioned to you that we accept the project as long as the return on investment exceeds the required rate of return. Now that's going to happen all the way back here. In this case, the internal rate of return of 23.3 exceeds all these discount rates. So it turns out also that that's where the NPV is positive, you see. This function is always positive for net present value. But it ends here, after which you shouldn't accept the project. You should reject it. So we're going to go step by step and calculate this curve known as the Npv profile. I've given you some values here to enter into your calculator. We're going to do this first, and then I'm going to show you how you can easily get the calculation without doing all these steps using the IRR key on your calculator. But the problem is that you still need to know how to do this manually, okay? Because your calculator doesn't solve for all the internal rates of return, and I'll explain what I mean. So take your calculator. I'm going to use mine. And what we're going to do is enter these values as though we're asking for the net present value. So I have to clear this second clear work to start fresh and enter the values of the project. The values of the project are here. So these are the cash flows anticipated. So I'm going to enter 2200 negative, enter down, and then 800, enter down, down, then 900, enter down, down, 500, enter down, down, 1600, enter down, down. Oh, I accidentally pressed that. Let's see what we have. So it's 2200, 800, 900, 500, 1600. And now I'm going to ask for the IRR, and it says 0 because I have to ask it to compute. That is the internal rate of return, 23.3, like I showed you on the graph. So now you have that, and I just did that with pressing internal rate of return. So it's an automatic calculation. So we're going to carry out a manual approach to getting that value, or getting close to it. And that involves using the NPV. So we're going to generate the NPV profile. Here I have the interest as 0, or the discount rate as 0, and I enter. Now the cash flows are still in there. I'm going to ask the calculator to calculate the net present value. Wait, let's see, I have to do I want to do 0, enter, down, and then compute. So that's the first value. That's the first value here. What I'm doing again is generating the profile. When the discount rate is 0, in other words, if the internal rate of return is 0, the NPV of that expression will be 1600. Now I'm going to change it to 5, 10, 15, 20. So I'm going to say, I tap NPV and then enter 5 down and ask to compute. And that's the second value, 1,126.47. 1,126. I tapped it by accident. Oh dear. Just tap it again. Go off. Top. I need to really get rid of this thing. It takes up my screen and I'm not even using it. I didn't want to do that. Sorry. That's giving the camera a screen. I'm not using the camera, but this is driving me crazy. All right, I'm back. Oh, sorry. Okay, so where were we? Oh, we got this value. Now, oh no, that's not where I want to go. So now I'm going to put 10% into here. NPV, 10, enter down, compute, 739.55. That's the next value. And they're getting smaller and smaller and smaller because the denominator is getting bigger and bigger and bigger. And I guess you trust me that the rest are there, but you should finish the profile, complete the profile to confirm all these values here. Okay, try that. I'll be right back. Any questions? Were you able to get these values? So, So this is known as the Npv profile, and it demonstrates where the internal rate of return will be found. It's not going to be 0%, it's not going to be 5, 10, 15, 20. It's somewhere between these two, because somewhere between there, it turns out that the NPV will be 0, because that's what we're calculating. Slowly, 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 the NPV is crossing the line. Now, where is it going to be? What can we do next to find it? Well, obviously we can just use our calculator to get it the way I showed you. But what are we going to do if the calculator can't get that? And I'll talk about instances where that's the case. Where the calculator can't get that, you need to blow up this. You need to repeat what we just did. Put a heading discount rate and an NPV. And then you pick some numbers. So we already know that 20 is positive. What about 21, 22, 23, and 24? We know somewhere in between there. Well, we should put, actually, let me put those place marks in for 20 and 25, because we might forget. So 20, 21, 22, 23, 24, 25, and I know this is negative, and I know this is positive. Now just keep going. So we're going closer and closer. Now what do you get? Well, these are all percentages. So, putting those in now. So let's see. Now if you got the hang of this, I'm going to say 21, compute, no, sorry, 21, enter, down, compute, still positive. Okay, it's 104.52. So I'll put that in. 104.52. So I'm going to keep going. 22. I'm going to say hit NPV and hit 22. Enter. Down. Compute. Still 58 is positive. 58.01. So this becomes 58.01. I know I'm going kind of fast. You guys can confirm this. Are we getting closer? Now we know the answer already because I cheated and I just used the internal rate of return key, which you are entitled to do. But I'm trying to teach you right now how to do this yourself in the case your calculator cannot get the result. All right, we just have to do two more. We have to do them all. 2 more. So 23 and 24. Not that one. So now I'm going to say NPV again. 23, enter down, compute. Still positive. Let's do 24. Just because I want to see. So that's 1302. Let's put it down here. We're so close. We're so close. We're looking for the 0. $24. NPV 24, enter down, compute. Aha! 3051 negative. 3051 negative. So I found that NPV is in here. NPV is equal to 0 in here. So what should I do next? Blow it up again. Between 23 and 24. One more time. Oops, didn't want to do that. So we blow it up again. Discount rate. NPV. And now we write 23.1, 23.2, 23.3, 23.4. So I know I'm gonna get to stop there. Yeah, 23%. 1302, right. 24. Oh, negative. Okay, thank you. So I know that in between here is where it goes negative. So now I'm going to blow this up and do these. Let's do it. 23.1, 23.2. So tell me what they are. I'll do it together. You guys do it and I'll copy it. Okay, so for 23.21, 8, these are all positives? No, it should be negatives, right? No, 23.1, yeah, positives, right? Okay. So 860, so close to 23.2. 420, very good, so close. 23.3, negative, so close. So it turns out it's probably between these two, but we're going to stop here and it just rounds to 23.3. All right? Are you sure? Yeah, you both get it. So this is probably just 23.3 and it's a rounded number, not 23.30. Let's see on my calculator again. Let's do IRR compute. Oh, because it becomes a positive, that's why. It must be. So if I put in 23, yeah, because it changed sign. What am I trying to say? Yeah. So it happens before 23.3. But then you round up. Okay, so the point is that it happens between these two. Okay, good. Let's just stop there. Yes. Yes, because it's going to be, it's 23.29 something. It happens up here between these two before this one, but then we round it. It rounds to 2 decimals, 0.30. Okay, everybody's good? So what did we do? Recap. We did what the calculator does. We computed the internal rate of return by iterating closer and closer to the internal rate of return. That is where NPV is 0. And so we generated this going down, and we crossed over, and we got closer and closer and closer to this. So now we have it. We understand where it comes from vaguely, right? Now how do we interpret? We know we're supposed to interpret accept the project as long as its rate of return, the project's rate of return, exceeds that which is required. Why? Because notice the NPV is always positive here. For all of these discount rates, if the firm picked any of these discount rates, they should accept the project. That's what we're saying. So if the discount rate was 10%, the NPV will be positive, so you should accept the project. If their discount rate, the required rate of return, the cost of capital was 20%, they should accept the project because NPV will be positive. Notice I'm talking about the NPV. Even though I calculated the IRR, this is understood and interpreted as the place where NPV is 0. That's why I'm talking about the NPV. So we can accept the project as long as the discount rate is no higher than the than this IRR. If it is, it means our project isn't good enough. It's not meeting that standard. Okay, so this drawing is very important. We generated it. You should practice it. I mean, technically you guys can do it, I'm sure, but understanding what you have got, only, a firm may have a required rate of return in mind. Or they may not. The beauty of the internal rate of return is it gives me a whole bunch of possibilities. So if the firm was indifferent, unsure that they were going to pick a required rate of return of 10 to 17, well, they don't have to pick exactly the number to calculate the NPV because they're all good. Any of them will give a positive NPV. It will be positive up until here. So I'm doing this so you can follow. Questions? No? Okay. So this says a firm may or may not have a predetermined required rate of return. The IRR gives you a whole range, so they don't have to be so specific, but they can see that the project is profitable. All right, next problem, unless you have questions. How many of you have done this before? How many of you have done this before? No comment? So no one has done this before? No one has calculated internal rate of return before? I need to know because we're going to be spending at least, well, maybe the rest of the class here, okay? I want to know how slow I need to go. Oh, okay, yeah, we need it. This is going to be detailed. Thanks, Kevin. Okay, ready? Who else? Anybody else? Okay, all right. Now that was an investment project. What is an investment project? An investment project is where the initial cash flow is a negative. Okay, Angel, thank you. The initial cash flow, initial outlay is negative, and the rest are positive. Okay, that's an investment project by definition. Remember, some of these words are used very loosely, and I'm trying to pin them down for our use. So this is an investment project. Initial outlay, revenues. Seems straightforward, right? Because you've never seen anything different from that. But what about this type of a project? Here you have an initial outlay that's a positive, and then future cash flows that are negative. What's happening here? Here, funds have been acquired through financing. In other words, like borrowed money. So this is borrowed. This is seen as borrowed or taken up front, and then the project is conducted over a 3-year period, and this is seen as the disbursement of funds. So for instance, let's say this was a project, this was like a trade show. So, you know, companies attend trade shows, and they bring their product to new markets, or they bring it, you know, to international markets. So they decide to, or let's say this company has a trade show or offers a trade show for potential vendors and people who are going to distribute their products. So they take some sort of fee up front, and then they take a fee for attending the trade show, and then they carry out the activities over the next few years. Okay, so things are flipped. The signs are flipped. And that's going to flip the illustration that we're going to do. Notice I'm setting the internal rate of return, I'm setting the NPV to 0, so this is the break-even project. I'm putting the internal rate of return, and I want to solve this. What is the return on investment? At what rate did the project break even? And I'm going to use that to compare to the required rate of return. Now notice, as the internal rate of return goes up, these will go down just like before, but now they're negatives. These are negatives that sum together to offset a positive. What's going to happen? So if you want to visualize this, it's going to be going in the opposite direction. As the internal rate of return increases, these negatives are going to be getting smaller and smaller and smaller against this positive. So it's going to appear like the net present value, the NPV profile, is increasing over time. Okay, now how does that change our analysis? First, let me make sure you guys got that. Any questions? So that this has to be a positive and the rest are negative. That's a finance project. These are the values of the net present value, or the NPV profile, that you can calculate yourself to verify. Don't forget how to do that. And you see between here, the NPV is 0. You could iterate between these two values and get closer and closer to the result. It turns out that the IRR is 14.37%. So we see it here. This is the IRR. And what does this tell us? If the firm's discount rate, if they required a 20% return, what should they do? What should be their decision? It looks like if the discount rate of the firm was 20, then the project would be a positive NPV project and it should be accepted. So beyond here, NPV is positive. Before there, NPV is negative. So here you accept, here you reject for all of these discount rates. Is this backwards from what we just did? It is. So how do we explain this? Well, we're going to talk, in this case, for a finance project, we interpret the internal rate of return as a borrowing rate. Rather than saying we want the required rate of return to be higher than the discount rate, we're establishing that the discount rate of the firm, or the required rate of return of the firm, is now interpreted as a borrowing rate. And we don't want a borrowing rate that's any higher than a certain amount. So this sets so here, for example, let me review. For a financing project, the required rate of return is seen as the cost of financing. Thus, you accept the project if the the rate you find, the borrowing rate of the project, is less than the threshold or required one. Not required, now you're going to see it as the cost of borrowing. So you want it to be low. You want a low cost of borrowing. Who wants a high cost of borrowing? So we've got to go from calling it, you know, it's the required rate of return. I still use the symbol RRR. It's the discount rate in the function for calculating NPV, but we interpret it as cost of financing. And we want, or we require, so now we're seeing RRR as the maximum. Before it was seen as the minimum. So it's just flipped. We flip everything. Okay. So as I said, you accept the project if the internal rate of return, if the required rate is above 14.37, you reject if it's below. The way I've written this, basically remember that it's a borrowing rate, and what we find as the IRR must be lower than the required rate. So work with that. I have some exercises that you can practice, okay? Ready for the next part? So those are the two main concepts. Basic NPV investment problem. Interpret the IRR as the rate of return, and it's the rate of return on the project. It's higher than required, accept. For a finance project, the internal rate of return is seen as the cost of borrowing, and you want it to be lower than the max allowed by the required rate. So you want low IRR, the other one you want high. So here you want it higher than the required rate of return. Here you want it lower. All right, so those are the two main types of analysis for independent projects. This was just to decide if we would pursue a project. If it's profitable, we'll do it. What does profitability mean? You need to compare to the opportunity cost, and that's why we do this NPV type of analysis, but looking at the IRR because we don't know exactly the discount rate we're going to use, so we get a range of values by doing it this way. All right, so what happens if we have to pick between two projects? What should we do? No, we're not there yet. Sorry, I apologize. Where we are first is we're going to continue talking about individual projects, but what if there's two rates of return?
internal rates of return. How can that happen? Well, mathematically, I've shown you that the function, as long as the first or initial investment is a different sign than all the future cash flows signs, then you have a monotonous function. It goes in one direction. But what if it does this? What if it curves? How could that happen? How could a curve happen? If a curve happens like this, where this is the NPV profile, you could have two, you see? So then what? So we have to learn how to deal with that. It's not clear until you do a graph, or at least the NPV profile, to look at positives and negatives, because you want to operate where net present value is positive. Always remember that rule. So in this case, in this graph, if the firm has a discount rate between these two, the NPV would be negative and you should reject the project. If the discount rate is lower than this but higher than this, we can accept the project because the NPV is positive. So IRR works with the NPV to make a decision. Okay, what would you do here in this case? If the NPV profile is always positive, well, you should accept the project, even though there's no IRR. So that's another kind of bizarre case. There's no IRR here. Well, that's fine. It just indicates that you should always, without reservation, pursue the project no matter what the discount rate set by the firm. It will be profitable. And what if the NPV profile looks like this? Well, it's the opposite. In this case, no matter what, you should never pursue this project. For all discount rates, the NPV is a negative, so it's not a profitable project in any case. So we're going to talk about, so you know what to do here, you know what to do here. You would have to generate this to be able to make your decision, because you might not be too familiar with these functions. So you make an NPV profile and get an idea of, you could just read it off of the chart, right? Negative, 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 positive. You get an idea of the pattern. You could plot it in Excel as a graph, or in your graphing calculator as well. So when does this happen? This happens when you get sign changes. For instance, when you go from a negative initial cash flow to a positive, so it looks like an investment project, but then at a later date, look how high this cash flow is, but it's a negative. This is enough to flip things around, so it creates a curve. So there's two sign changes, negative to positive, then positive to negative. This means that there's up to two internal rates of return, and you have to try and find them. If you have the HP calculator most of the time will be able to find both. The HP calculator is able to find both. But the TIBA2 Plus can only find one. I don't know about any other calculator that people are using, how many it can find. You're going to have to let me know if you can get more than one. And I'll teach the people with the HP how to get that one. All right, so let's see. Here are my cash flows. For this example, negative cash flow in the first year. So this is the replication, right, of what I just did. And I called it different names. Anyway, so here is the set of cash flows, and I've already generated the NPV profile, and you see I went all the way back to negatives because you can do that. You'll see mathematically this polynomial, I think that's what you call it, because I think that the powers are in the denominator, but it's a complex function with that kind of a graph. It's possible that you have negative discount rates, right? Just mathematically, it goes off into the negatives, which is fine. Negative rates would imply that you're actually, these are returns. These are actually payments. So we won't worry. We're just going to use it for mathematical purposes to try and find the internal rate of return, but we're not going to use any discount rates that are negative, okay? Because a firm will not pick a negative discount rate. So anyway, don't worry about that too much. We need to put it in to try and find our two required rates of internal rates of return. So when I put a negative 10 in, I get a negative NPV. I put a negative 5, I get a negative. I get a negative all the way up till somewhere between 10 and 5. It turns from a negative to a positive. And then when I continue, it's positive, and then it turns to a negative. So between these two, I have positive NPV, and these are the limits for the discount rate. All right, so let's see if you guys can get that. Put these in the calculator and see what you get. I'll put it on mine, and then I'll also show you in the HP. All right. All right, so I'm going to hit CF. Second, clear the worksheet. And then enter 260, negative, enter, down. 250, enter, down. 300, so down. And then 300, enter, down, down. And 20, enter, down, down. And 340, negative, enter, down, down. So let's see what I have. 260 negative, 250, 1 frequency, 300, 1 frequency, 20, and then 340. Very good. Now I ask for IRR compute, and I get the first one, 11.52. it doesn't give me the other one. And in the HP, what you can do is you can overshoot the other value that you kind of approximate. So in this case, it's like 23. I'm going to put 30 into store. No, it didn't let me do it. So 30 into store 1. No, that didn't work. 30 into store 1. If you do that in the HP, it will help you generate or iterate towards the second one. But in this case, it's not going to work. If I say compute again, it doesn't work. So let's try it in the HP. Oh, now I have to remember how to enter into HP. So maybe I'm not going to do it. Oh yeah, you have to hit this key. Clear. Maybe not, because I don't remember how to use this. I'd have to remember. So that clears cash flows, maybe? Not sure. Nope. Oh, I'll just do clear all, see what happens. So clear all, okay, so there we go. And I want to enter these cash flows, 260 negative. Is it possible? Did that work? And then 250, that's the second one, and 300. Yeah, no, I'm going to repeat. I have to do CF0 on a different key, right? Initial cash flow key. Someone can tell me. Because I think there's initial cash flow key. I used to use this 10 years ago. There's an initial cash flow key somewhere. See CF0, so it should be 260 negative. But how do I enter it? Let's see if you guys have any idea. I think it's the plus, right? Got ambitious, but I don't remember. Is it a plus? Let's try. Let's just go for it. Okay, 250, 300. The thing is that it's counting without the, I don't think it's working. 340. No. Well, I need to look into that before I show you that. But anyway, the idea for the HP calculators, you would put in a value 30, oh, that didn't work. So 30 second store 1. And then with that, you can recompute the IRR and it should find the second one. I need to review how to put it in the cash flow keys. Daviana, weren't you using the HP? Remind me. Wow, I can use this. Cool. So these different methods, let's see if I can do this. 260. 250. 300. 20. It's actually building the worksheet. Look kind of cool. 340. And then that's it. And then what? It gives me my IRR. It gives me one of them. Oh, it gives me both. There they are. Can you see them? So small. It's there, but I can't see. So they're down here. Can you see those values? I calculated both. No, I don't want that. Okay, back to the calculator. So there they are. So if I put in second store 1, anyway, I got them in the Excel sheet, so there you go. That's the best I could do. So there are ways to do things that you can find online, or with some diligence you can figure out yourself. So those are the two internal rates of return. I approximated them with the Npv profile, and I know that in between the Npv is positive. So I can display that. It's going up and down. This is where Npv is positive. So you should only accept the project if the discount rate is estimated to be, so if management decides that their discount rate should be between 10 and 30, then you can go ahead with the project. If they only had a 5% discount rate in mind, this should be rejected, or if they required more than 30%, the project should be rejected. Okay, so that's your answer. Any questions? No comment? No comments, no comments. Continuing. So we have the finance project, we have the investment project, and then we have multiple IRRs, multiple internal rates of return. Here's the next one. So what do you get when you plug those in? What's your internal rate of return? Since there are sign changes from a negative to the positive and then positive to a negative, there are up to 2 internal rates of return that we should find. Did you get one? Did you find one? So you can generate the NPV profile for yourself here. Using interest rates I'll give you, usually in the assignments and things, I will tell you which ones to use, but I'm going to say start at -30, which seems extreme, but we really want to find the 2 of them, and we're going to have to go back. So go from -30, -20, -10. Let's do this. We're going to do it broadly, and then we're going to, again, focus in. So let's just do -30, 0, 30, 60, and 90. Try those and see what happens. So clearing my worksheet first, entering 900, enter down, 1200, enter down, 1300, enter down, and 1200 negative, enter down, and then ask for compute. So you get negative 29.35. That's why I went down to negative 30%. So what I'm going to do, that's one of them, and then there's another one. So let's presume it's higher. And that's why I picked values going higher. Otherwise, there's no way to do this. So let's put in negative 30. We're going to go by 30s. So we're going to enter, we're going to hit NPV and enter 30, enter down, and compute the NPV. So it's a positive 246.11. I missed 0, right? That's for 30. Yeah, so I was 30. Let's make it negative 30 because that's what I wanted to do. Okay, enter down and compute. Okay, so it's a negative 31.20. So negative 31.20. This is negative 31.20. What if the discount rate is 0? If the discount rate is 0, so I'm hitting NPV. I'm going to hit 0, enter down, and compute again. Now NPV is 400 for an I of 0. So mathematically, this turns out to be 400. Because, it's just a matter of, if you have 1 plus 0 on the bottom, these are all just with a discount rate of 1, so you're just basically adding those together and you get 400. So what we've done is identified between here and here, there's an IRR. Then you'd have to blow up that area, expand it and look for it. And then for 30, compute 246.11. We saw that already. 246.11. It's starting to go down. Hit 60. Let's try 60. Or hit NPV. So 60, enter down, compute. It's 64.84. Still going down. And then 90, if I put, these are all percentages, if I put 90%, it's going to go negative. Negative $83.26. Very good. So there's another one in here. So to zero in on what it is, you would have to expand this region and this one. and you would generate this profile. Now these are wild rates of return, but what we go for, what we tell management is basically this is the situation like this one here, where I mentioned if the IRR is always positive except, now in our case it's not always, but I mean not the IRR, when the NPV is positive always for whatever discount rate, even though there's no IRRs except, but in our case there are internal rates of return, but they might as well not even be there, because management is not going to pick such a high or a negative internal rate of return. So it looks like the NPV, this is the only reasonable range, and it looks like no matter what discount rate they use, this is an always profitable project. So accept the project as long as the required rate of return for the firm would be between 0 and 73%. This is a very high required rate of return. It's not very likely to exist. So, like I said, so we don't talk about negative. I mean, and a firm will not pick a negative rate of return or something so high. So we're comfortably going to accept this project. Let's look a moment at the cash flows. You see, so these are quite high. Well, they offset. They give you a positive anyway. They give you a positive net present value in that range. So you understand the importance of incorporating all information about expenses and revenues into these calculations if you're going to make such a decision to say, I'm going to accept this project even though the NPV is very small. You should have incorporated everything. Okay? The cost of doing business, all of that, to justify, accept the project. All right, next one. So you're going to practice this after class. I'm just going to jump to the graph. So here you have the NPV profile that was determined, and I talked about this sort of a case. Here you generate it, right, picking different discount rates. It turns out that as long as the discount rate is between 0 and 8% or higher than 34%, you should accept the project. But anything in between there, reject. So this is a result of the kinds of cash flows that you have. Notice there's this disproportionately, high cash flow at the end. So this favors low discount rates. So you have the sign changes from positive to negative and then negative to positive, which says up to 2 internal rates of return. And then you have the magnitude, the relative magnitude of these amounts. So high discount rates are okay to retain the magnitude of these cash flows early on, but also a low discount rate, it favors this cash flow of a positive over here. So that's why you get this result. Okay, so accept the project provided the required rate of return is between 0 and 8% or greater than 34%. It's often the case that discount rates are between this range, so it's probably going to be a rejected project. Okay. All right. Any questions? No questions? Okay, so let's talk about, so that was everything I've said so far has been about independent project analysis, looking at one project and evaluating it, whether it's profitable. Now I'm going to look at mutually exclusive project analysis and in the context of the internal rate of return. And because the internal rate of return is, so it's tied to the net present value, that's going to be raised as well, and how to deal with that. All right, so there are some problems when you're comparing two projects and deciding which one to pick. If it's the case that let me do that again. So which project should you take? The blue project or the red project? Or either of them? If this is the NPV profile of both of them. Red or blue? But no. Ignore this for a second. Just look here. No, I'm asking you about this. Which project would you take? Red or blue? So all I've done is displayed like we were before with, one project. We had an NPV profile. This is the NPV profile for two different projects. Which one is better? Can we say one is better than the other? So Kevin and Angel say yes, the red one is better. Yes, because for whatever discount rate, it always has a higher NPV. So we should pick the red one. Okay. So what if Which one should you pick now? The green or the gray one? Okay, he says green. What else? Who else has a guess? Okay. Who else? Well, green should be the project you pick if the discount rate is higher than this. And gray should be the project you pick if the discount rate of the firm is lower than this. Okay? So it's not clear here which one. It has different conditions. So I'm going to teach you when this happens. Well, it doesn't matter about staying longer, Kevin. It matters. Only one of these are going to be the firm's decision. So it doesn't matter that it has more options. The firm is only going to pick one. Anyway, I understand your point that this looks long, but the firm is going to pick one discount rate, or say, a range of discount rates. So I didn't even put a range here, so it's hard to argue that these are better, more likely discount rates than any of those. So I haven't even said, the kind of projects. I've just been showing you cash flows, but let's talk a little bit about projects before I continue, because I've been focusing on the numerical aspect. I'm going to lose my mind with this. Okay. This won't go away. This line. That's why I hesitate to use that function. All right, ignore that line. Oh, now it's covering. That's not what I wanted. Okay, go away. There. All right. So projects. So these projects could be a firm looking at a decision to expand. All right. It could be a company considering a new brand so like Macy's looking at a new brand to offer. So they do some analysis about costs and benefits. It could be about a manufacturing plant thinking about introducing a new type of vehicle. So these are all projects for firms. And as I explained, deciding between alternatives, whether a firm's going to, do alternate brands, okay? So here it's clear if this was a specific new label for jeans for Macy's, and this was something for suits for Macy's, then this one clearly is better. But then in some cases it's unclear. It's not for lower discount rates you pick the gray, for high discount rates you pick the green. So how can this happen? One problem is a scale problem. When you're comparing high budget and low budget projects, it's not clear which one to pick when you use the internal rate of return or without a graph, okay? The internal rate of return is going to give you the wrong answer if you just calculate it and you rank them. It's going to give you the wrong information. If we go back, which I really don't want to do, go back to this drawing because it's not nicely put together. I can't join it. So this is kind of what I produced. I'm going to redraw the scale because I want it to cross the scale. So here, this is what your IRR would be here and here. And so if you were to say, pick the one with the higher IRR, it looks like the green one. But that completely ignores our discussion about the relative, the relative comparison between the two. It misses the point completely. Okay, so this could happen because of a problem of scale. And here's my example. Let's say you have an opportunity with me to give me $1 now, and at the end of the class, I give you $1.50. Compare that with opportunity 2, where you give me $10 at the beginning of a class, and then I give you $11 at the end. If you were to calculate the net present value in dollar terms, you get more money with the higher budget project. This is provided we have to assume here that you have either of those in your pocket or in your bank account or available to you. Okay, so we have to assume that outright. Then it looks clear that you're going to get $1 here. You're only going to get 50 cents here. Project 2 is the better one. Or opportunity 2 is preferred, applying the net present value rule. So you get the right answer. But when you compare with a percentage, this is going to be done with, like, relatively speaking. 50% is what it looks like you've made here in the first project, when you've only made 10% here. But that's not what you want to compare. When you have two projects that are different scale, the first one with lower amounts of money, 50 cents looks like a lot. And the high one, budget project, looks like, minimal, just to add another dollar onto 10. So you could avoid this by only comparing similar budgeted projects, but we're going to find a better way to do this overall. Okay, but the thing to remember is the NPV rule gives you the right answer. But what about the internal rate of return? Because we like the internal rate of return since we don't have to pick a discount rate to make the calculations. We like that. We don't have to predetermine one. We can look at a range of possibilities. Okay, the other type of problem is known as a timing problem, and we've seen this already where I showed you in the cash flows of multiple internal rates of return, where you had, like in here, modest cash flows early on, they grew, and then by the 4th year they're quite high. This stream of cash flows favors a low discount rate to maintain the magnitude of the 200, the positive cash flow, against this one, negative. Now these two are similar, so it's not like a low and high budget project issue. It's just the timing of the cash flow. So this one, the cash flow is early, the early cash flow is high, so this one wouldn't care too much for a high discount rate. Okay, so this one tends to allow for higher discount rates to give you your IRR, and this one requires a low discount rate. So in comparing them, this is the example I showed you with the gray and the green. It looks like you should pick project B because it has a higher internal rate of return. But that's not clear. When you go to the NPV to check, it turns out that, if you don't have the discount rate, you can't calculate an NPV. And when you make a drawing, just like the one I discussed, this is project A, and this is project B. Project A favors low discount rates. Project B likes high ones. So you can't just say, this is higher, we're going to go for it. We need to combine these projects to make them relative so you can compare them. So it's not this case where it's clear cut that B is better than A. Sometimes A is better than B, and sometimes B is better than A. And since we aren't pre-specifying the discount rate, it's hard to know which. So what we do is we combine these projects in what's called an incremental project. And we analyze that. So we collapse these into just going to check. Okay. So I'm going to write A minus B. So this is the incremental project. A over B. So we're going to test, or we're going to analyze whether we should pick project A over B by putting them together and then analyzing that stream of cash flows. So you subtract A's cash flows by B's cash flows. So 350 negative minus a negative is like adding. So this is negative 100. This one is going to be negative right? Negative 75. This one will be 0. This one will be 75. And this one 150. Now we don't have to look at these anymore because they've been combined into this, the incremental project. So we return to analyzing a project as an independent project, and notice there's only one sign change from negative to positive. Now the first cash flow is not just negative, the first two are, but this is going to be straightforward in that we're going to analyze it. It doesn't have multiple IRRs, it should just have one. It will have one. And it's going to be interpreted as an investment type project. Okay, these are important things. There's only one IRR because it goes from negative to positive, and that's it. All right, so when you put those into your calculator, what do you get? Ask for the internal rate of return. No comment? So when you enter these into your calculator, you find the internal rate of return is 8.07. What does it mean? It's where these two cross. You see, this black line is the new project, the incremental project of A over B. And what it says is that A should be chosen as long as the discount rate is less than 8.07. Otherwise, B should be chosen. Okay. So that's how we work with that. So you accept project A over B provided that the required rate of return is lower than 8%. Otherwise, you pick B instead of A. we analyze the incremental project as an investment, financing in general, financing or multiple IRR project depending on the pattern of the incremental cash flows. So in this case, that's why I've talked about it the way of understanding it as the return. This is the required rate of return. I mean, this is the return on investment. That's why I've analyzed it like this. It is higher than, as long as it's higher than the required rate of return, we should accept. All right, you guys got quiet. Questions? So the last type of investment rule or decision rule. So we've so far done the NPV, which is in dollars. We talked about the payback period and the discounted payback period. Those were in years. We talked about a lot of time talking about the internal rate of return, which is a percentage. So we have absolute dollars, we have years, and we have percentage. What about fractions? What about ratio? The profitability index is a ratio, and that's what we're going to talk about next. Now, in the exercises I shared with you, I also shared the answers with you. Try not to lose the answers. I mean, look at the answers and try and reproduce the question. What am I trying to say? Reproduce the answers on your own, okay? And then check with the answer key. So what is the profitability index? So rather than with the NPV, we do like a cost, like initial cost plus the present value of future cash flows. So that's like a cost benefit analysis. The internal rate of return is like, we're doing the same thing because it's the NPV formula, right? So we're doing cost versus present value of future cash flows. In the ratio, what we're going to do is take the benefits divided by the cost. It's just another way of looking at things. And in terms of the internal rate of return, we really like the internal rate of return because it gives us a single value. We've learned how to deal with, I've taught you how to deal with multiple IRRs and how to work with mutually exclusive projects properly, to use the tool properly. But there is a value in the profitability index ratio that we're going to discuss. So we're going to take benefits over cost rather than benefits offsetting costs. No, it's here. Angel. It's here. Accept incremental project A or B provided that this is greater than, this is the answer. This whole thing is the answer. All right, so I'm going to make a ratio as I promised. The total present value of future cash flows divided by the initial investment. So what this is the net present value. So what I've done here, as opposed to using the present value future cash flows, I've taken the whole NPV and added back the initial investment. So it's just because you might have that in your calculator from calculating it for other purposes, right? You want to get the NPV, you want to get the IRR, you probably have it in your calculator. Add back the initial investment and then divide by the initial investment. I'm using CO. This is the positive, this is like I'm taking the sign off basically for the investment amount, because it enters as a negative cash flow, right? And you should accept the project as long as this ratio, the numerator exceeds the denominator. So you want the ratio to be bigger than 1. You should select the alternative. If you have several to choose from, several different projects, select the alternative with the highest profitability index. Like the IRR, the profitability index also suffers from that problem of mutually exclusive investment, that you need to make them relative. You need to calculate the incremental project as opposed to just calculating the PI and ranking it. Just like the IRR, you shouldn't pick the one with the highest IRR. You should combine them and make an incremental project and analyze that. That's because they might cross over. The NPV profiles might cross over and it's not clear what your answer is. We like the PI because it's easy to understand and communicate. It gives you the correct decision when you're evaluating independent projects, and it may be useful when available investment funds are limited. So this is the case of capital rationing that I mentioned right at the start of the class. So it has specific use for that reason. When you can afford more than one project, but you have to figure out which combination of projects are suitable. It helps you do it efficiently. So here's an example. So get the NPV first. Calculate the NPV first, and then you can get the profitability index. So I'm going to clear work and begin with 1100 negative as my initial cash flow, enter, and then 500 for the first year, enter, 1 frequency, and then 1,000 for the second year, and then ask for NPV. They're told to use a hurdle rate of 10%. That's another word for the cost of capital. They say hurdle. You know what a hurdle is? In track, you have to jump over the hurdle, or in hurdle is an obstacle. So it's like a threshold that you have to beat. So it's useful for the required rate of return. So they call it hurdle rate. So there's all these words to mean the same thing. So I'm going to say 10. Enter, down, and then compute NPV. And the answer is that it's $180.99. So the NPV is $180.99. And then to calculate the PI, I need to add back the initial investment and then divide by that amount, but not the negative version, the positive version. So we don't do this for finance projects, okay? This is for investment projects, usually, at least in this course. So this is 1.2, which is greater than 1, so we accept the project. Why is it good? Because it gives you more bang for your buck. It's an expression. You get more than you paid for. You get more than you put in. 1.2. Okay? So with that, I gave you a lot of information. I know it's been 3 hours. I didn't take too many breaks. So I'm going to leave it here, go through all those review exercises, and I'm going to wrap up with the last few pages. You guys can read those pages, and we'll talk more tomorrow. Okay? I'm going to send you the new notes for tomorrow. We're going to start capital budgeting. Did you take capital budgeting in 3106? So what capital budgeting is basically coming up with these cash flows. We're going to learn about how we come up with these cash flows. So it's like taking a step back. I've just taught you these techniques so we can use them, but where do these come from? We're going to go deeper into deriving these, and that's going to be for this week. And then next week, we're going to go deeply into deriving the discount rate or the hurdle rate or the cost of capital. That's what we're going to spend time on. I'm trying to get back to the original problem. Here. Okay, so we're going to learn about how we get that. All right? No capital budgeting. So you guys don't know what that is. So that's basically what we're going to do. We're going to learn about how to derive these. We're going to talk about revenues, expenses. Probably did it in accounting, maybe, not in 3106. Something like it. Okay, so have a good day. I'm going to leave it here. If you have any questions, please let me know. I really want to grade your papers today and have them back to you for tomorrow, so you get the feedback right away. So goodbye for now.